All right, I'm gonna go ahead and make myself a little bit bigger here. There we go. Welcome, guys. Awesome. So we are recording. So if you are watching this video, it's because most likely you have opted in some way to want to buy owner finance properties with the Barr Realty team. My name is Colin, Colin Barr, so team leader of the Barr Realty team. And whether you're working with myself or one of my team members, we are grateful to be able to work with you and looking forward to, in this course at least, just providing a lot of value. You'll find that we offer value first before expecting anything, and that goes throughout the whole team. And in this course, I'm really just going to be covering upfront and pertinent information for owner finance. And I don't want to keep it, or I don't want to make it go too long. I'm just going to cover the basics, but enough to where that we can have a good conversation, productive conversation, and see if it's the right fit for you. So I'm going to go ahead and minimize me here. And let's go ahead and jump into it. So owner finance for buyers. Let's find home. This is a complete course, navigating today's market with confidence, in the website you can go to below. All right, so my goal for this course is pretty simple. Like I mentioned, it's just to give you enough confidence with information and demonstrating credibility so that you can make the decision for yourself whether owner finance might be the right route for you to go to. And if you do decide to do owner finance, hopefully by the end of this, you'll know that if you decide to work with us, you're in great hands. All right, so a disclaimer is if you haven't already reviewed the About Us property information packet, then I really highly recommend going through that first. Anybody can make a video on the internet, really, until you read a little bit of About Us or at least have a conversation with one of us. This is kind of meaningless. Why? There's no trust. There's no relationship intact or in place. And so I really recommend, if you haven't received a buyer introduction packet, going over who we are, the values, some case studies that we've helped clients with, then I really would pause this video and then go through that first. So with that being said, let's go ahead and move forward. All right, so owner finance versus traditional. What's the difference and which one is the right one for you? So you can see right here, owner finance, you don't need a bank or lender involved. And so you have a lot less regulations. So that's a big plus for people who are considering owner finance, as just not as many regulations as traditional. With traditional, a bank or lender is involved directly, and the buyer must follow all their regulations and processes to obtain a loan. And this, from personal experience and client experience, is just a lot more stressful process. So that's typically why people want to go owner. Now, with owner, credit score can be less of a factor. It depends on the seller. Obviously, the seller in owner finance is who is going to be basically lending the money to you. And so with that being said, some sellers will want to look at your credit score, and some of them will not. They don't care. They just want to make sure you have the down payment and are making good money. And so it just depends on the seller. With owner finance, you have more flexibility to negotiate terms. Now, what are terms? Terms are things like interest rate, balloon, closing costs, who pays commissions, who pays owner policy, things of that nature. Those are all negotiable and all terms. With traditional, terms are typically set by the lender or current loan rates. That's talking specifically about interest rates, which is true in traditional financing. That's set by the Federal Reserve, which trickles down to loan officers and lenders. So outside of that, though, just going beyond just interest rates, in owner finance, you will see that almost everything is negotiable. And so I really like that, especially as an agent, an experienced agent. I can fight more and harder for my clients. So going back to traditional just for a second, going back here, credit is much more important in traditional financing. You probably already run into this where, to get approved for a loan, you may need a 580 or a 620 credit score. If you don't have that, then they're just flat out not going to approve you. And also taxable income has limits with debt to income. It's interesting. Lenders and banks, they will look at all your debt, and essentially if you have too much debt compared to your income, they will not give you a loan. However, with owner financing, that's not necessarily the case. With owner financing, even if you have a lot of debt, but you're making enough money to where the seller is like, okay, let's do it, then you can still buy that home. And then lastly, close time. With owner financing, you can close as fast as 10, 20 days. Very fast. It just depends on the title company and your partners and all of that. So, but with me, you have great partners, so no need to worry. Traditional financing, it takes 20 to 45 days to close, so a lot longer. If you're in a time crunch and you need to move quickly, owner finance is definitely the way to go, or if you just don't like to wait. All right, some questions to ask yourself. These are super important. Do I have money for 10% or more down payment? So with owner finance, sellers typically will almost always require at least 10% down. Very rarely have I found somebody who will do less than 10% down. That's because the seller is typically the one that pays all the commissions and most of the closing costs. And so we'll get into that later, which you'll see. Another question to ask yourself is if I don't have 10% down, or if it's cutting close, like I barely have it and it's going to drain all of my savings, maybe a question you should ask yourself is, should I work on increasing my credit score with one of my loan officers? I can recommend you to a great loan officer who will help you get your credit up, and as little as 30 days. So if you don't have that 10% down, you'd rather do like a 3% or even 0% down, then you might need to increase your credit score. That might be the better route for you. But that being said, it's not just about credit score. You have to take in, like, if your taxable income is high enough on your taxes, if you have taxes, or if your work history is spotty or not. Those are all factors. So what has held me back from buying a home in the past? This is just more of an introspective question I want you to ask yourself. The reason I put this in here is because, as all real estate agents, we have all had that client that we were working with, typically when we're younger in our careers. But you go through the whole, do the whole dog and pony show, find them the home, they love the home. It comes time to wire the money or sign the contract, and they just kind of get cold feet and blame it on some other reason other than the service that you've provided. And so I would just ask that you just think, do I really want the responsibility of homeownership? And if you do, or if you have like questions that you want answered as far as what does that responsibility look like, my team and I are more than happy to go over that with you, just to set real expectations, just because we want to provide a great service, but at the end of the day, we also want to protect our time as well. And so I would just ask yourself, have I overcome these obstacles, or am I even willing to? Is a fair question to ask. But let's get into it. So how much home can you afford? Just going beyond the purchase price. Now, I've already mentioned this, but very rarely will you find a seller willing to accept less than 10% down. This is because they're paying out all the fees. Closing costs, like I mentioned already as well, are all negotiable based on the deal. If you find a seller that has had a very hard time selling their home and they don't have a lot of showings, they don't have a lot of offers, they don't have a lot of leverage, you have more leverage in that situation. And so we can probably get them to cover majority, if not all, your closing costs. Vice versa, if home is very nice, it's priced very well, and they have a lot of showings and even offers, then we don't have as much leverage. We would have to most likely pay our closing costs in that situation. Now, ongoing costs, these are monthly principal and interest, just like on a regular loan, taxes and insurance, just like on a regular loan. But you also have what's called a note servicing fee. We'll get into that later. And you have maintenance and utilities, just like on a regular home. All right, let's go ahead and move me out of the way. There we go. Additional upfront costs. Now, again, I have to reiterate this, like this is setting proper expectations of what could happen. These are all really based on your situation and the deal itself. Like if we find a seller that is very motivated, then you're not going to really pay all of these. It just depends on the deal. But to set realistic expectations, earnest money deposit is typically 1% of the sales price. So if you're buying a $350,000 home, that's $3,500. I don't always put $3,500 in my contracts. I put even as low as like $2,000, but that does go towards your down payment. So that's very important. It does go towards your down payment. Home inspection, I would recommend getting a home inspection unless it's like a very new home. I would always do a home inspection because it could save you thousands of dollars later on if the inspector finds things that are wrong with the home or things I may have not caught because I'm not an inspector. Then, that's why we have these done. And they range from $400 to $700 depending on size of the home. Moving costs, this is subjective. Take it for what it's worth. It could be a lot or a little depending on how far you have to move, but factor that into your budget. Initial home repairs, especially if this is an older home, you need to look at things like how old is the roof, the AC system, how old are the appliances, how old, do I need to replace the countertops? Anything like this, you need to factor into your budget as well. Home warranty is optional, but typically if you want it, it's $300 to $600 for the first year, and it covers things like appliances and like your HVAC or AC system. Very important. I want to note that I will provide an example of all expected closing costs. I'm going to actually show you a deal that we went through and did. And so on that deal, there's a page where it shows all the closing costs and how they're dispersed out line by line. And I'm going to show that with you. And that's honestly pure gold for you to see. All right. So this is important. I want to help you understand if you're not familiar, maybe you are familiar, but maybe you're not, about how much an interest rate determines pricing, such as monthly price and also long-term price. So I just want you to understand where your money is going. Very important. So let's look at this example. In this example, you're buying a home for $350,000 at a 6% interest rate. Now, if we go here, we can see that the house price is $350,000. 10% down payment is $35,000. Loan is at 6% interest rate. You can see your principal and interest is almost $1,900. You can see that your insurance is $145 and that your taxes are about $583. A fun fact on this for taxes, if you homestead the house, make it your primary residence, depending on the county the home is in, you can get up to 10 or 20% even off of your taxes. And on top of that, this principal and interest, part of the interest that you pay on a home can be written off at the end of the year when you do your taxes. So this 2617 payment, if you do your taxes right, you're going to get reimbursed, and it is going to be like you're actually paying more like $2,300 a month. And so don't get it like twisted, like you're still going to pay that 2617 per month, but tax time, you'll get reimbursed. And so it would be like you would be paying $2,300 a month, give or take, if you do your taxes correctly and you do your homestead primary residence. So you can see the cash to close on this is almost $41,000. Now that's the 35 that we talked about, plus some closing costs. You can see the prepaid costs of $51.51. That's 14 months of property insurance up front. That's 4 months of property taxes up front. That's 15 days of interest up front. Now, these are mostly all, honestly, most of the time you do need to cover the insurance yourself since it is your policy. Very rarely have I seen a seller willing to pay that for you. The taxes, in the example I'll show you towards the end, we actually didn't have to pay this. It just depends on who you work with. That's why you're working with me and my team. And then the interest you would have to pay, you or the seller. So really this would come down to about 2,700, but there are some other fees that we'll get into later. This is really just to show you the difference in the payments. So let me show you. Let's go to a $300,000 home at an 8% rate. The payment is almost the same, notice. Let me go back. 2618, 2606. You're buying a less expensive home, but the rate's higher. So the payment is the same. And so the next question would be, well, what's the best, situation? The best situation would be to get the highest price home at the lowest rate possible. That's your best situation. The worst situation would be a lower price home at a higher rate. We don't want that. So the first kind of constraint we're going to look at is how much do you have in your down payment? Do you have the 10% or more? That's the first constraint. That tells us what price points we need to be looking at or under right off the bat. From there, we're going to go deal by deal by deal by deal and see which one of those deals has the lowest interest rate. And this is just from me calling the listing agent and saying, hey, I see, we're interested in this property. We've already shown the property. What interest rate is your seller, starting at or interested in? And the one that we can get the lowest rate on is typically going to be your best deal. And that's how that works. So balloons, if you're not familiar with owner finance, there are a thing called balloons. So I'm going to cover what they are and how long, should you have one. So a balloon is a common element. Essentially, it means the total balance that's going to be due to the seller by the time the balloon is over. And so it depends on the loan amount, interest rate, and how long the balloon is until it's due. So let's just look at a contextualized example just to make it easier to understand. Let's say in that same example that we did, $350,000 home, you do $35,000 down. Your mortgage is $315,000 now. You do a balloon in 2 years and you're at a 6% interest rate. Your monthly payment is $1,888. That does not include taxes, insurance, HOA, and note servicing fee. That's just your principal and interest. So the monthly payment is that. And the balloon payment you'll see in 2 years is basically $309,000. That is what is due to the seller in 2 years. It's less than what the mortgage amount is because you're paying down your mortgage over time. But there is interest associated with that. So that 6% interest rate really factors into the balloon payment. If you get a lower interest rate, your balloon payment is going to be much less. Let's look at this example just to show you the difference in time. Same situation, the only difference is your balloon is due in 5 years instead of 2. Now your balloon payment is only $295,000 instead of the $309,000, but you paid more in interest because you're paying a longer, the balloon is longer. So you're kind of burning more money on interest, but you're doing that in order to buy yourself more time to either refinance or pay the whole thing off in cash. Those are your two options at that point when the balloon is over. And some people don't even get balloons. It just depends. Some sellers don't even want you to have a balloon. They will be okay with you just having it like 30 years, like a regular, loan. And in that case, you don't have to refinance or pay it off in cash. But you're going to be paying them a lot of interest over that 30 years, just like you would at a regular bank. And that's okay. I mean, there's nothing wrong with that. But if you can, I would recommend, refinancing, whenever is the best for you. So balloons continued. I kind of already went into this a little bit, but balloons are basically paid by getting a refinance done by a bank or a lender. So this is very important. Whenever your balloon is due in 2 or 5 years, you will need to be ready to be qualified through traditional lending, meaning you need to have that credit score ready. You need to have that good work history ready. You need to have that enough taxable income claimed on your 1099 or W-2. You need to have all those things in place when your balloon is due, whether it's 2 years, 5 years, 10 years. Okay. Or pay it off in cash. Those are your options. So a example of this is, let's just go through that same example and what would happen when that time comes at year 5. You have that refi or that balloon due at 295. So at year 5, the home will appreciate. Let's say the home appreciates. You bought it at 350, and now it's all the way up to 400,000. So you have that in that's what the home is worth now, and you can use that money. So it'll be worth more. So you can use that value to pay off the remaining $295,000 and start a new loan with the bank and lender for $295,000. So what you're going to do is the bank is going to lend you money based on your home, right? At that point, if you qualify with the work, the credit, and the debt to income, they're going to give you a loan. And let's say they give you a loan for $295. You're going to use that $295 to then pay off the seller and the balloon, and you're just making payments on that $295 to the bank. And that's how it works. Or you don't do that and you just pay it off cash. Here's a lot of information. I'm going to try and go through this, quickly but efficiently. Owner finance transactions need to have a note servicing company. So this is super important. Let me actually put myself up here so I can talk to you directly. Owner finance companies need to have a note servicing company. So what that is the reason they're important is you don't want to make payments directly to the seller. That's a big no-no. You want an intermediary or somebody in between you and the seller. And that's what a note servicing company is. They will be a third-party company that receives your payment and then pays both the mortgage company, the person who owns the original loan from the seller, and they pay the seller if there's a difference. Let me just walk you through an example so you can help understand it. You're paying all in with taxes and everything. You're paying $2,500 a month for your owner finance deal. Let's say the seller is only paying because they have a current loan on that house. Maybe they're only paying $1,800 for that current loan. So the $2,500 you're going to pay to a note servicing company. That note servicing company is then going to pay the $1,800 directly to the mortgage company, and they're going to pay the difference to the seller. So in that situation, $700 will be going to the seller, and the $1,800 will be going towards the notes or the mortgage company. This is super important because we don't really want the mortgage company to know that anything has changed. They just need to keep getting their payments. That's all they care about. And we pay them. The note servicing company pays them directly. So in addition to that, and by the way, I already have a note servicing company for you. I've done business with them. I know Ginny very well, and that's a huge value added from me to you. Now, in addition to that, owner finance transactions need to have an attorney because the attorneys will create a trust to help for your protection. This is super, super important. A trust, putting a property into a trust, will protect you 99.9% of the time from the mortgage company calling the loan due. If you ever heard of that, you know what I'm talking about. If you haven't heard of that, sometimes extremely, extremely, extremely rare that a mortgage company will call the loan due. Basically, they're saying that, hey, we noticed that the title changed. We're now calling that loan due in full. The reason that we're putting it into a trust is to avoid them finding out the title has changed. And that's how that's done. You can talk with my attorney and my title team. They've done this for 20 years, and they have very, very, extremely, very, very rarely ever had a loan be called due. And so talk with them and utilize their experience over mine. So attorneys can be expensive. Luckily for you, like I just mentioned, I have found a title company that with an attorney inside of the title company. So you don't have to go to both. And that's going to be really hard. If you have an attorney and you have a title company who don't know each other, who aren't used to working together, that's going to be a very stressful process. Don't do that. Go to a title company with an attorney inside of the title company. They're used to doing business together. And also it's a reduced cost to do that as well. Which is probably just as important. So it saves you money. Luckily for you, I already have this in place. Special property insurance agents are also needed for owner finance to help prevent against the loan being called due. Luckily for you, I already have these connections as well. So for any other transaction, you need property insurance. The seller, once we do this, is going to terminate their property insurance. They no longer pay that. But you do need to pay property insurance. And so that will, that having the insurance policy being created by somebody who's used to doing these owner finance deals is very important. All right, on to the next one here. So here's the goal that I was gonna, promise that I was gonna share with you. I can't zoom in on it, but let's just take it for what it is. So this is like I said, a deal that we did that's owner finance, and it's gonna go line by line as far as how the fees are being paid out. And you can see exactly what all the fees are. Super, super important. Now at the top, you'll notice paid from seller's funds at settlement. So when we close, this is paid from the seller. The seller paid both the listing agent commission and the buyer agent commission on this deal. The borrower, which would be you, the buyer, only paid a loan servicing setup fee to Polaris Management. That's the note servicing company with Ginny that I mentioned. They paid interest and they paid homeowners insurance because they had to, remember, they had to get their own insurance policy. So they paid that. They also paid, title insurance, $100. They only paid a little bit of the recording fees, an e-recording fee, and some other recording fees to the county. Now the seller paid everything else. The seller paid owner's title insurance, so they paid for the title insurance. They paid the settlement fee from both a buyer and seller to the law office of the title company that I use. They paid trust documents because we put the property in a trust. They paid owner's T3 endorsement to the title company. They paid a USPS reimbursement to something that does need to be mailed out, and they paid tax certificate, and they paid, look at this, sub 2 wrap management documents to the law offices of T. Allen Kisher. So sub 2 wrap mortgage management documents. This is basically an attorney's fee for doing this wrap or owner finance mortgage. They're interchangeable. Wrap, owner finance, sub 2, it's all the same thing. It's just different forms of it. But that's a $3,500 charge, plus you have the trust documents. So maybe in a different situation, the buyer, you would need to pay your trust documents and your management wrap costs. It's just all negotiable. It's all based on the deal. So, but just as a fair warning, this was like a very one-sided transaction to set proper expectations. We just had the seller cover most of it because they were in a bad spot. Right. So, and then the seller paid the HOA, all the HOA, and look at this. The seller had they're basically behind on their loan. So they had to pay some late fees and shortage fees and everything else. So the $35,000 that is actually $30,000 in this one, that my client put down, but that $30,000 was used to cover all of this. And you'll actually notice that her total out of pocket was $35,579, but we were only giving them $30,000 down. The seller actually had to come to the closing table with a $5,000 check to get this property sold. So she actually paid to get out of this deal, which again is super rare. Out of all of the deals that I've done, this is a very rare example, but it can happen if you find a seller that's in a bad enough situation. So here we are. Let me go ahead and make myself smaller. You are here right now. If you're watching this, you're just trying to get more information to see if this is the best thing for you. And after this is when we would do a buyer consultation. This video, what I did, is not a buyer consultation. This is just a course explaining to you what owner finance is. That way, when we even get to the buyer consultation, things can move a lot more quickly. And so this is where you're at. If you like what you hear and you're like, yes, I want to go buy an owner finance home, it does not matter if you want to do that in 6 months or a year. We need to sit down, either in person or in a virtual meeting, and have a buyer's consultation to go through everything. What is on this screen is what we'll go through in depth. This is what I just did. This course is just a nuts and bolts owner finance. That this does not include the actual going through the transaction process. And so highly important. I need to double down on this. Even if you're 6 months out or a year out, let's schedule a virtual or in-person meeting. I'd love to meet you. Either me or one of my team would love to meet you. We're going to uncover your needs, what you want in a home. We're going to make a strategy based off of what you have to put down and what you want to be at monthly. And we're going to set proper expectations and get you financially prepared to go ahead and buy that home. Only after the buyer consultation is when we will go ahead and look at and send you homes. The reason this is super important, I have to reiterate this. I don't want to send you a home that's outside of what your price point is, because when I do that, it just creates an awkward and not a very good experience. Why would I send you a home that you maybe fall in love with, but you can't afford it? It just doesn't make sense. And so only after the buyer consultation, once we know your numbers, what you want to stay at, is when we will send you homes to choose from. But in order for that to be real, we need you to be real with us and give us your real numbers. But we'll send you the homes after that, and we're gonna send you a list. We're gonna look at maybe 10 homes on that list together, and then we're gonna filter down to the top 3, maybe 5, but probably top 3. And then we're gonna schedule those 3 all in one day to go and look at, and we're gonna view them. And then after each one, I'm gonna ask you to rate that home based off of your needs, and the one with the highest rating is the one we'll potentially move forward and write an offer on. We're going to write an offer. I'm going to write an offer, and I'm going to send that to you to sign off on. And then I'm going to send that to the listing agent for them to sign off on. They might counter the offer, and we might have to do some negotiating back and forth. But once everybody has signed, then the offer goes to a title company, and then the title company is going to process that, get the title transfer ready, order the HOA resale docs if they need to, and do all the trust setting up of the trust and everything in a note servicing company. We're also going to have an inspection done at that time. An inspection, like I said, is super important unless the home is super new. And we're going to renegotiate if we need to, if we find something really bad in the inspection. After that, we can close. I mean, that's really, seller finance is very easy. There's no lender or bank involved, and so we can close quickly, 10 to 20 days. And me and my team will help you with the utility transfer, getting the keys, and scheduling that closing with the title company. So that's pretty much it. I hope you have enjoyed this. I hope it's been massively, massively valuable to you. That really is the goal of this, is just for me to provide an absurd amount of value upfront. And hopefully by doing so, you choose to work with me and my team. We would love to meet you and work with you. Just go ahead and reach out to us, and we'll get that either a phone call or meeting set up. So, all right. I hope this has been helpful, and have a great one. Thanks.